A guy spends 34 years working for a mid-sized manufacturing company in Ohio. He maxes his 401k every single year starting at 31. He watches it grow from $12,000 to $40,000 to $200,000. He gets promoted twice. His wife keeps working. They live below their means. They drive used cars. They don't take the trips their neighbors take. And at 65, he retires with $1.4 million in his 401k. He did everything right. He followed the rule book that was handed to him by every HR department, every financial article, every commercial with a sailboat on it. He was supposed to be fine. He was not fine. A woman in her early 60s, teacher for 32 years, $680,000 saved across a 403b and a rollover IRA. Combined household income in retirement is expected to be around $74,000 a year, which puts her and her husband comfortably in what feels like middle-class retirement territory. She retires at 63. Everything looks okay until she realizes that her required distributions starting at 73 are going to push their income into a tax bracket that triggers Medicare surcharges she never modeled, eats 22 to 24% of every dollar she pulls out, and effectively claws back a portion of her Social Security benefit through a mechanism called the provisional income formula that nobody explained to her at any point in 34 years of teaching. A third guy, software engineer, 51, $920,000 in a traditional 401k. He's been told he's ahead of schedule. His Fidelity dashboard shows him a green progress bar at 94%. He feels good about retirement. He has not run a single calculation on what his tax bill will look like at 73 when the government forces him to start withdrawing whether he needs the money or not. He's sitting on what he thinks is $920,000. He has never asked what that account is worth after the IRS gets their share. What's the pattern? My name is Archer, and I spend way too much time thinking about the gap between what people believe they've saved for retirement and what they'll actually be allowed to spend. If you're someone who has been doing everything right, maxing your accounts, following the conventional playbook, and something still feels off when you do the math, subscribe and like this video. It will help more than you think. Here's what we're going to cover today. First, I'm going to show you why the 401k was never actually designed as a retirement system, and why that origin story matters for what's happening to your money right now. Second, we'll break down the math behind required minimum distributions, the mechanism the government uses to collect taxes on your deferred savings, and why that math gets genuinely punishing at higher account balances. Third, I'll explain the Roth conversion window, which is the narrow window most people don't know they have, and why most people are going to miss it entirely. Fourth, I'll show you the difference between two people with identical account balances who end up with completely different retirement incomes, not because of market performance, not because of contribution rates, but because of one decision made in their early 50s. And fifth, I'll give you the specific protocol I'd follow right now if I were starting this process from scratch, including the exact calculations and thresholds to check tonight. By the end of this video, you'll understand exactly why the account balance on your Fidelity or Vanguard dashboard is not the number that matters. The number that matters is what you'll actually net after taxes, after Medicare surcharges, and after the government's mandatory withdrawal schedule forces your income into brackets you didn't plan for. The vault metaphor. Now, before we get into the numbers, I need you to hold one image in your head throughout this entire video. Imagine you spent 30 years filling a vault. You sacrificed vacations, drove older cars, said no to 100 small luxuries, and you put the money in the vault instead. Every month. For 3 decades. Now here's the thing about this vault. You don't own the combination. You never did. You were always a co-owner with a silent partner who let you fill the vault without any restrictions and promised to let you take money out whenever you wanted, as long as you paid them their cut at the time of withdrawal. That silent partner is the IRS, and the cut they're owed isn't fixed. It's determined by tax law, which can change, by your total income in any given year, which is partly forced on you by a withdrawal schedule you have no control over starting at age 73, and by a handful of other income thresholds that most people have never heard of. The vault is full. The combination is not yours. That is the situation. I want you to remember that vault, because everything I'm about to show you comes back to it. The problem: how the 401k was built on a broken assumption. Let's start with where this whole thing came from, because the origin of the 401k is one of the stranger stories in American financial history, and it explains a lot about why the system works the way it does today. In 1978, Congress passed a tax reform bill. Buried in Section 401, Paragraph K, hence the name, was a provision that allowed employees to receive a portion of their compensation as deferred income, meaning income they wouldn't pay taxes on until they took it out later. The original intent was narrow. It was meant to give executives at large corporations a way to defer bonuses and compensation into a future tax year. It was not designed to be a retirement system for the American workforce. It was not designed to replace pensions. It was a tax accounting provision that a benefits consultant named Ted Benna figured out could be repurposed as an employee savings plan in 1980. Benna himself has said he created a monster. Here's why that matters. The 401k replaced the pension as the primary retirement vehicle for most private sector workers, not because it was a better system for workers, but because it shifted the investment risk from the employer to the employee and allowed companies to eliminate the guaranteed defined benefit obligations they owed their retiring workforce. In the early 1980s, about 60% of private sector workers had a defined benefit pension. You know what that number is today? Under 4%. The pension didn't fail because it was mathematically unsound. It was dismantled because it was expensive for companies to fund. The 401k replaced it. And the entire premise of the 401k, the tax deferral, was built on one assumption that nobody examined closely enough. That assumption was, you'll be in a lower tax bracket in retirement than you are during your working years. Now you might be thinking, well, that's true, isn't it? My income will be lower in retirement, so my tax rate will be lower. And for a lot of people in previous generations, that was accurate. The person with $200,000 saved in 1990 who retired on $30,000 a year, plus Social Security, was probably fine on that math. But here's the trap. The math changes completely when your account balance gets large. And because the 401k has been the primary savings vehicle for 40 years, and because the market has delivered extraordinary returns during that period, a significant number of people who followed the rules perfectly now have $600,000, $900,000, $1.3 million, $1.8 million in tax-deferred accounts. And the math on those balances does not look anything like what the TV commercials promised. The math, RMDs, tax rate risk, and the hidden bill. Let me show you the actual mechanics. Required minimum distributions are the government's mechanism for collecting the taxes you deferred. Starting at age 73, you are legally required to withdraw a specific percentage of your traditional IRA and 401k balance every year, whether you need the money or not. The percentage is calculated using IRS life expectancy tables. At 73, you're required to take out roughly 3.77% of your account balance. At 80, it's about 5.35%. At 85, it's about 6.76%. At 90, it climbs past 8%. This sounds manageable until you run it on a large balance. Let's do the actual accounting. Someone who is 60 years old today with $800,000 in a traditional 401k, contributing $10,000 a year with an average 7% annual return, will reach 73 with approximately $2.1 million. That's the good news. Here's where the vault starts to matter. At 73, their required minimum distribution is $2.1 million multiplied by 3.77%. That's roughly $79,000 that year, whether they need it or not. Now add Social Security. If they delayed to 70, they're collecting somewhere around $36,000 to $45,000 a year, depending on their earnings history. Combined income between $115,000 and $124,000 per year. Sounds fine, right? Here's the problem. That income level puts a married couple at the top of the 22% bracket, pushing into 24. It triggers IRMAA, surcharges on Medicare Part B and Part D premiums, which currently add between $2,000 and $8,000 per year in healthcare costs and that most people never modeled. It causes up to 85% of their Social Security benefit to become taxable, which is a threshold that hasn't been adjusted for inflation since 1993, meaning more and more retirees trip over it every year. And it leaves almost no flexibility for a major expense like home repair, a health crisis, or helping a child, because every dollar they pull out beyond the RMD is taxed at 24 to 32%. Here's what's actually happening in that scenario. They filled the vault for 34 years. They arrive at retirement technically wealthy, and then the combination gets turned over to a system that forces them to take money out on a schedule they don't control, in amounts that push them into brackets they didn't plan for, triggering surcharges on benefits they assumed were separate. The vault is full, but the effective tax rate on the contents is not what was advertised. Now here's where it gets worse. Because there's a second mechanism that compounds this problem, it's called tax rate risk. And most people have never even thought about it. Here's the thing nobody talks about. The 2017 Tax Cuts and Jobs Act reduced individual tax rates across every bracket. The The top rate went from 39.6% to 37%. The 25% bracket became 22%. Rates came down significantly. Those cuts are scheduled to expire at the end of 2025. As of early 2026, the political situation around their extension is unresolved. If they expire without congressional action, rates revert to their 2017 levels. That means the 22% bracket becomes 25%. The 24% bracket becomes 28%. For someone pulling $100,000 a year out of a tax-deferred account, that's a difference of $3,000 to $6,000 in annual taxes, from nothing but a change in the law that they have zero control over. And here's the longer-term version of that risk. The United States federal debt sits at $36 trillion as of early 2026. That's 120% of GDP. To put that in terms that are actually useful, it's the equivalent of a household that makes $60,000 a year, carrying $72,000 in high-interest credit card debt, while still adding $5,000 to the balance every month. The IMF puts the threshold where debt to GDP starts to constrain fiscal options at around 90%. We blew past that over a decade ago. At some point, I'm not saying tomorrow, I'm not saying 2028, I have no idea when, the structural pressure to raise tax revenues creates a political environment where higher income tax rates become more likely than not. And every dollar sitting in a traditional 401k is a dollar that hasn't been taxed yet. That's not a conspiracy theory. That's what the Congressional Budget Office has published. That's what international fiscal watchdogs have written in papers that nobody reads because they're 800 pages long. It's just math. And your vault full of untaxed dollars is sitting in the middle of it. Mark versus James. Let me show you what this looks like on two real people. Mark is 57 years old. He's a project manager at a construction company, has been for 28 years. He's disciplined. He's been maxing his 401k since he was 35. He currently has $1.1 million in a traditional 401k and $85,000 in a regular brokerage account. His wife Teresa is 55, works in hospital administration, has $340,000 in a 403b. Combined, they have $1.525 million in tax-deferred retirement accounts. Their kids are out of the house. Their mortgage is paid off in 4 years. Mark intends to retire at 63. He's on track, says his Fidelity advisor. He's done everything right. Let's run his numbers. By 63, Mark's $1.1 million at 7% returns over 6 years becomes approximately $1.65 million. Teresa's $340,000 with ongoing contributions becomes roughly $640,000. Together, they'll arrive at 63 with around $2.29 million in tax-deferred accounts. Mark can live on $75,000 a year. He delays Social Security to 70. He thinks he's fine for 7 years by just spending the $85,000 in his brokerage, plus a small amount from the 401k. Then at 73, the RMDs kick in. On $2.29 million, and that number has grown further to approximately $3.1 million by 73, assuming continued modest returns. His RMD alone is $116,000. Add Social Security of $43,000. He's at $159,000 in forced income. He doesn't need $159,000. He needs $75,000. He's paying taxes on $84,000 extra dollars he didn't want and didn't need, at 24 to 32% every year until he dies. He cannot put it back. He cannot undo 28 years of contributions. The vault is full and the gate is permanently open. Now contrast that with James. Same age, same income history, same company. James made one decision differently. At 52, after reading about Roth conversions, James started converting $50,000 a year from his traditional 401k to a Roth IRA. He did this for 8 years. He paid the taxes at the time, roughly $11,000 to $12,000 per year, which he covered from his brokerage savings. He moved $400,000 out of the tax-deferred vault and into a Roth account where it will never be taxed again. Not the contributions, not the growth, not the withdrawals. And there are no required minimum distributions on a Roth IRA during the owner's lifetime. 0. James arrives at 73 with $1.8 million in traditional accounts, $620,000 in a Roth, and a much lower RMD, roughly $67,000 instead of $116,000. Combined with Social Security, his forced income is $110,000, not $159,000. He's in a lower bracket. He avoids the IRMAA surcharges. His Social Security is taxed at 50% rather than 85%. And when his RMDs force income he doesn't need, he pulls from the Roth to cover his actual spending without paying another dollar to the IRS. Same salary as Mark. Same discipline. same market, completely different tax outcome. Not because James was smarter, because James understood the vault analogy 8 years earlier than Mark did. The difference in after-tax retirement income between Mark and James over a 20-year retirement could easily exceed $300,000. From one decision, made in 1 decade. That's not a financial planning nuance, that's the ball game. Imagine a financial seminar from 1987. Guy in a suit, overhead projector. PowerPoint didn't exist yet, so it's actual slides. Save 15% of your income in a tax-deferred 401k. It grows tax-free. You take it out in retirement in a lower tax bracket. You sail into the sunset. Cut to 2026. Same guy. Same suit somehow. Same slides. So about that lower tax bracket thing. Turns out if you did really well, if you actually followed the advice, your RMDs push you into a higher bracket than you were in during working years. Also, tax rates might go up because of the debt situation. Also, there's this Medicare surcharge thing we didn't mention. Also, your Social Security is 85% taxable now. But other than that, solid plan. Really held up. Why most people won't act and what to do instead. Here's the kicker. None of this is the fault of the people who built the 401k system. They weren't lying. The math worked fine for the account balances they were imagining in 1980. The problem is that the system was designed for $200,000 account balances, and it's now being used by people with $1.4 million and $2.1 million and $3 million. Nobody went back and updated the instruction manual. The financial industry has little incentive to tell you about this because a significant portion of their business model involves managing large tax-deferred account balances. Your tax optimization is not their primary business problem. Your balance is. This isn't a knowledge problem anymore. You now know. This is a behavior problem, and there are 2 very human reasons why most people won't act, even though the math is obvious once you've seen it. The first is present-day pain aversion. Roth conversions cost money right now. You pay taxes today for a benefit that materializes in 15 years. Your brain is not wired to do that. Evolutionary biology gave you a reward system optimized for immediate returns. Paying $12,000 in taxes this April to save $40,000 in taxes in 2041 requires overriding a deeply embedded preference for now over later. Most people cannot sustain that override across multiple years without a system that makes it automatic. The second is complexity paralysis. The tax code is genuinely complicated. IRMAA surcharges, provisional income calculations, Medicare Part B thresholds, Roth 5-year rules, pro rata rules for backdoor Roths. The sheer number of interacting mechanisms makes most people put this in the I'll deal with it eventually pile, and eventually becomes never. The solution to both is identical. Automate the decision so you make it once and it executes itself. Here's the protocol. Action step 1. Tonight, log into your 401k and write down your projected balance at retirement. Then run your RMD on the IRS calculator. Takes 90 seconds. Add Social Security. If that combined number is above $94,050 for a married couple filing jointly in 2026, you have a structural problem that benefits from Roth conversion. Action step 2. Open a Roth IRA if you don't have one. Fidelity, Vanguard, Schwab, 0 fees, no minimum, 15 minutes. Action step 3. Calculate your conversion sweet spot. Convert enough each year to fill your current tax bracket without going over. If you're paying 22% now and expect to pay 24% in retirement, converting at 22 saves money on every dollar moved. Action step 4. Automate the conversion. Set a calendar reminder each January. Convert before you can second guess it. Action step 5. Do not do this alone. A fee-only fiduciary advisor, not commission-based, is worth the cost here. The NAPIEFA directory lists advisors legally required to put your interests first. Fee only. That distinction is not marketing. It's a legal standard. Closing in 3 takeaways. Here's what I want to be honest about for a second. I got this wrong for longer than I should have. I maxed my 401k without ever modeling the tax side. I watched the balance grow and felt the dopamine hit every quarter when the statement arrived. It wasn't until I actually sat down and modeled my projected RMDs at 73, which took about 45 minutes in a spreadsheet, that I saw what was coming. The number was fine until it wasn't. The tax exposure wasn't visible until I looked for it, and by the time I looked, I'd lost a few years of conversion opportunity that I could have used in lower income years when the conversion would have cost less. I'm not saying this will happen to you. I have no idea what tax rates will be in 20 years. Nobody does. I'm saying the math I showed you is not a fringe scenario. It's what happens to people who followed the conventional advice perfectly and never asked whether the deferred tax bill was part of the plan. Based on current law, current account balance trajectories, and the fiscal pressure of a $36 trillion debt load, the risk of higher taxes in the 2030s and 2040s is meaningfully higher than the risk of lower taxes. I'd rather pay a bit more now at a known rate than gamble on an unknown future rate that's more likely to go up than down. The vault you've been filling is still a good vault. The goal is to understand who holds the combination, what they're owed, and whether you've built the kind of flexibility that lets you manage the payout on your terms rather than on a government-mandated withdrawal schedule. 1. Your 401k balance is not your retirement income. The number that matters is what you net after taxes, Medicare surcharges, and a mandatory withdrawal schedule you have zero control over. Take 20 minutes tonight to run your projected RMD and add it to your Social Security estimate. That combined number is your actual starting point. 2. The Roth conversion window is real and it closes. The years between your early 50s and the year you start Social Security are often your lowest income years of adulthood, the window where the tax cost of converting is lowest and the benefit longest. Most people miss it entirely because it requires paying taxes today to save taxes in a future they can't fully see. 3. This is not a knowledge problem. The math fits on a single page. The obstacle is that paying taxes now to save taxes later requires overriding a neurological preference for immediate reward that evolution spent 200,000 years installing. Build a system. Automate the conversion. Make the decision once so you don't have to make it again. If you want to see how the Social Security delay decision interacts with the Roth conversion window, there's a video on my channel that walks through the exact timing math, numbers included. No affiliate links, just math. The vault is yours. Make sure you know what the combination costs.